Our guest says, particularly focusing on the S&P 500, we're still in a momentum market. There are built-in expectations of accelerating economic earnings growth and economic expansion. Let's get more from Patrick Horan, principal at Agilith Capital. Patrick, always great to talk to you. Thanks very much indeed.
And thanks for having me on, Andrew.
I think a lot of your analysis right now we're going to be talking about is focused on the S&P 500. Is that right?
Yeah, well, we can transfer it to Toronto as well, the TSX. That's fine. It's they're somewhat interchangeable. I think the S&P in particular is weighted towards growth and big cap tech, and I think that's probably the area I have the most concern about going into 2025.
So you argue that the S&P 500 is up not far short of 30% this year, but the earnings gain has been only 8%. So obviously that implies a higher multiple, more optimism in the market.
That's right. That's right. There is a lot of positive news already priced in, and that's what gets me worried because we're not seeing the half full argument here that expectations are high. We've positioned ourselves for a steady climb up, probably a smooth ride, which we've had in 2024, and Trump and geopolitics is going to be anything but smooth. It's going to be messy and fraught with a lot of potholes. I don't want to be too down because I actually do see a positive return for year end. I see a better return for the TSX than the S&P, primarily because the multiples are so different, where you have a very high growth rate priced into the S&P, and you have, I would say, a modest growth rate still priced into the TSX. Yeah, so we do have a bias towards the Toronto-based stocks or Canadian-based stocks, and we actually don't hold a U.S. stock at the moment, and have kind of been positioned that way for probably the past year and a half.
With no U.S. stocks.
With no U.S. stocks, and we've done just fine this year.
Right.
So our returns match pretty close on par with the S&P, but we haven't had to take valuation risk in doing that, and we feel pretty good about that.
Right, but you say I mean, we can't get into your total returns, etc. But you say that you've matched the S&P 500, even though you didn't hold U.S. stocks.
Correct. Yeah.
Okay.
Yeah. We're very cyclically biased. We had a lot. There's been a hidden rally here that has been completely overshadowed by tech and AI and Trump and geopolitics. The hidden rally has been in small caps and mid caps. More towards the value side of the market. It's been choppy, but we've done very well in them, and we were positioned for the start of the year. We actually haven't made very many changes this past year, and we actually don't anticipate making many changes this next year. I think one of the key things is that inflation as a concern over the long term is now starting to price in, and I think that's helped the small caps and the mid caps, especially on the value side.
Just focusing on the S&P 500, you argue that this multiple expansion is arguably pricing in years of strong earnings growth.
That's right. And earnings matter until earnings start to fall, and then it collapses, and then people, the market tries to find its bottom. The problem is that the value side of the market, the guys who typically try to buy the falling knives, it's way outside their zone. So. I can see a lot of air pockets. And the other thing too is we haven't actually had a more than a 10% correction in, I don't know, a year and a half. And that kind of concerns me because there are a lot of weak hands that are long this market. And weak hands, to me, end up being air pockets and dramatic, probably like what we saw yesterday, just a dramatic down in stocks that where you sort of go, what has changed in 24 hours? Not much. So
when you say weak hands, of course, that's traditionally stockholders who are likely to sell, get nervous reasonably readily.
Yeah, absolutely. They're speculative. They're not sure why they're doing it, other than it's working for them, and so the conviction when it's not working becomes quite low, and the weakness comes from really the insecurity of them understanding that they don't really understand why they're into these stocks. They don't usually sell them at profits. They usually sell them at losses, and that's kind of the problem. That after a market decline, you see a lot of these guys come in and just either get cleaned out because they have a margin call, or they really lose all kinds of confidence in what's going on. The market, our view is that the market isn't an efficient mechanism of pricing and valuation. It's a moving pendulum of emotion, and our job is to see through that and to actually find what is longer term attractive and alpha generating for a portfolio. I don't mind volatility. I don't mind down markets. I do have some skepticism in up markets, especially like the S&P, which has done phenomenally well. Let's just go back in history for a second. The S&P, its total returns over the past 50 to 100 years has probably been around 7 to 8%. Over the past 7 or 8 years, I think we're probably around 10 or 11%. Now, what has really changed in the earnings growth picture or in economic productivity? I would argue not a lot. We still have good growth. We still have a growing society and a healthy outlook. But the global economy just hasn't shifted up and to the right like the valuations have. So that's really my contention.
Thank you very much, Patrick Horan.
Good to be on the show with you.
Thanks very much. Principal at Agilith Capital.